Hi, everybody, sorry for the slight delay. We just technical difficulties trying to get in. But anyways, Office Hours event, September 22nd, 2022. We are now getting started. So I'm Colin Behring, and we also have Peter Bibler with us. And we've got a couple updates today on a few things EB-5 and policy and process related. Then we're going to go straight into the FAQ and the open roundtable with investors. So again, thank you. And Peter, why don't you just kick us off and lead us away?
Sure. So today we're just going to cover a few things. With each office hour session, we'd like to highlight start off with at least one FAQ that a lot of investors ask us when we have our one-on-one calls with folks. So today we'll focus on the common question: do I need to invest 100% at the time of filing, or can I invest in stages? And then we'll talk a little bit about our current project, 1900 Broadway, and give a construction update. And then talk a little bit about the market. You know, it's one thing to build a great asset, but it needs to be in the right location for real estate, right? So we're going to talk about why this project makes sense where it is, and why we're very optimistic and excited about this project being online as early as next year. And then we'll open up the questions. Again, this is what the office hours is all about. So many of you who are online now or have registered, we've already talked to. So I'm glad to see folks that we know, and look forward to answering your questions. Feel free to, again, just use the chat function to submit your questions. And if we don't get it to it right away, then we'll be sure to answer during the Q&A session. So as I mentioned, very often, almost every time I speak to a prospective investor, the common question is, when do I need to invest? And do I need to invest all at once? And so generally speaking, with the EB-5 program, you're investing the minimum capital, $800,000, at the time of filing the I-526E petition. But the law and the actual forms themselves recognize and state that you can be actively in the process of investing at the time of filing. And we pioneered this what we call the partial payment approach in 2017, and we've had many investors take advantage of this option and be approved as well. So we'll talk a little bit about what it means and how you structure it, and how this could be available to you. So again, this is a copy of the form itself, or the new I-526E form that's been published recently this past summer. And you can see, I highlighted here, that you can show that you're actively in the process of investing. And you will highlight you list the amounts that you're investing and the approximate dates that you anticipate to invest. Now, all the capital needs to be in before your I-526 petition is approved. And there are a couple other caveats here too, and we'll talk about that. But here it's just showing you that the form itself and the instructions indicate that you can do this. Obviously, most projects don't do this, and the reason for that is, they typically need the money up front. They're overly relying on EB-5 capital to start the project or to construct the project, and whereas, as you'll see shortly, our project is already under construction, well underway construction, and as such, we can be flexible and work with families who need additional time to assemble the capital. These situations typically involve where an investor is selling real estate overseas, or working with family members on gifts or loans and transferring funds overseas. And this all takes time. And the partial payment approach allows you to invest a minimum amount of capital at the time of filing, typically 20-25%. File your I-526 petition, and then fund the balance of the capital within 6 to 9 months or in some cases up to 12 months. As I mentioned earlier, you want to have all the funds invested before your I-526 petition is approved. But you also need to pay attention to the construction project. So you want to make sure that your funds are deployed into the project before construction is completed. That's the simplest case to show USCIS for your job creation requirement. So this can be very advantageous for investors because it enables you to lock in your priority date when you file your I-526 petition and get your place in line for the reserved visas or the new visa set-asides that we talked about last week. It also enables you to, if you're in the United States already, to file your adjustment of status petition. So long as you are filing the I-526 petition with a partial payment approach, doing a partial, you can still do the adjustment of status. And there's no impact on your immigration processing, provided that you complete it on time. So it's something that we can work with you on if you need this option. And we'll work closely with your lawyer to draft the proper documents to show that you are making a commitment and not simply a deposit plan or a contingency plan for this partial payment to be successful and be approved for you. So Colin will talk about the 1900 Broadway and kind of share with folks kind of the exciting news of our progress so far.
Yeah, and then talking about 1900 Broadway as well as its current construction status, where it's at, but also, why is it beneficial and why does the EB-5 investors, want to consider certain projects in certain stages over others, and really just a discussion of risk. The ability to look at projects that, on paper, they might list very similarly side to side, where it says, it's an apartment building or it's real estate and it's construction-based jobs, and the jobs have, an extra job creation buffer and creates, way more jobs than you need. But projects typically side by side have incredible differences, and we'll talk about that and also answer questions that you may have on what you really should be looking for, and how to look at these deals and kind of know the difference between A, B, or C, etc. But as a lot of you know, 1900 Broadway, it's a 39-story tower, actively under construction, actively creating jobs. 100% of its job creation is through the construction alone. So every time we pour a floor of concrete, every time we buy materials, every time you buy or you pay for labor, every single contract that goes in these buildings turns into job creation. At this point in our job creation cycle, we've actually already created nearly 1,500 plus jobs, 1,600 plus jobs every single month on a project of this size. And according to the job creation study and the multipliers that we get with the RIMS 2 model, we're creating nearly 100 full-time jobs every single month that we're building this thing. It's very, very different than having operational style jobs like at a hotel, a restaurant, something hospitality, or something where there's physical people that are counted, their W-2s, tax returns, social security numbers, all that stuff being collated and sent to USCIS. We have indirect job creation, and we can talk a lot about that in the regional centers advantages, but this indirect job creation and totally construction based on a project that already has all its financing, its bank guarantees, the completion guarantees, and how these things work together is incredibly important. Project like this that has a construction completion guarantee essentially is guaranteeing the construction jobs. So one thing leads to another, and the EB-5 investor benefits both ways, because one, the completion guarantee is going to guarantee that the construction happens, but it also guarantees that you're going to end up with a marketable asset that could be sold and then recovering all the capital. So it's a win-win scenario all the way through. As we mentioned, we're about halfway up, over 22 floors out of 39. We're already putting glass on the building, and we're about a year away from delivering the first phase of units. So you have a truncated level of schedule, truncated risk. You have an ability to really see the progress, and dealing with specific construction, we've already mitigated a whole bunch of risk to actually building projects and where you get stuck. The most dangerous part of any major urban infill construction project is when you're below grade, below ground, when you're digging a hole, when you're trying to figure out waterproofing, when you're trying to get the basements and the deep foundation piles and trying to dig in a tight urban setting. There have been projects in EB-5 past, not our projects, but there have been projects that because of geotechnical instability, they failed entirely. And that was after taking hundreds of millions of dollars of EB-5 money and then pouring it into a project that couldn't even get out of the ground. How is an investor really supposed to know that? It's very, very difficult if you're just reading a document that was sent to you on a flyer for marketing. But then when you have an opportunity to go into projects that have already succeeded to a point where they're out of the ground, they've already passed these dangerous parts of a construction process, we've already started to check these boxes, and now we're kind of on the home stretch, just delivering the superstructure of the building and just finishing the interiors. So a lot of risk that you may or may not have known about has already been completed. And with a project like this that only has a couple spots, it's in its later phases of construction, later phases of fundraising, it is a significant difference. And it's why a lot of professionals and a lot of the agents that are in this industry, they're always going to try and migrate toward a project that has already mitigated as much risk as possible and still able to accept EB-5 capital. And that's a rare combination. With that, I do encourage everybody, please, with the chat desk, please go ahead and throw your questions in there. We have one that's come already, but as we're saying things, and if there's anything new to you or something you have a question about or you want clarification, use the chat. We see all of them and we're going to answer them. So let's use the platform as much as we can, and we'll go ahead and start answering questions as we go. But the 1900 Broadway project, again, 22 floors out of the ground. We're going at a pace of 1 floor per week. We'll be topped out at all 39 floors toward the end of the year, if not January of 2023, and delivering next summer. So basic update there. As we showed, 1900 Broadway's, it's a trophy quality tower in an irreplaceable location. We had a little bit of fog here because of San Francisco, but you can see a straight shot across the Bay Bridge into San Francisco. If you turn to your right in this building, you'll see the clock tower at UC Berkeley. It's 3 BART stops away, a 9-minute travel time. It's only 17 minutes to San Francisco from here. And then if you turn to your left, you can see the rest of the bay in the Alameda Estuary toward Oakland Airport. Incredible location, incredible tower, and the full package for EB-5, really. So different shots, the superstructure, again, every single floor, every single window, everything translates into job creation through the regional center's indirect job creation profile. So then just, some quick updates. We've had people over the last week just ask directly, hey, how's the market doing? Because the stock market is completely kind of going to hell here, and you have interest rate changes and you have all this stuff. Like, tell us about Oakland. Tell us about the market and what's going on. And ultimately, Oakland is shaping up for a massive run coming here in 2023, 24, 25, and beyond. And that's because Oakland had a tremendous amount of supply delivered early. And that was 2018, 2019, and into 20. And then COVID hit. And then the oversupply plus COVID really slowed down the market directly early. And there was almost zero construction that has taken place outside of 1900 Broadway since. But as opposed to what the newspapers and headlines are saying about a California exodus or a Bay Area exodus, it's actually not showing up in any of the data. We just recently had an updated report commissioned talking about demographics, macroeconomic indicators, things like that. It is actually expected that our direct competitive market area in downtown Oakland and everything else by the time 2025 and 2026, we're expecting to see nearly a 12% population growth of the downtown core. Part of that is because there was a lot of construction being completed and those apartments are going to get filled up. There's a lot more residents going to be in downtown Oakland, but also San Francisco still remains incredibly expensive and also has no supply. Growth in San Francisco will translate into growth in the East Bay. Constrained supply in both markets essentially will fill up Oakland. So the details, I know these reports are not very pretty because they're so dense and all the numbers are so small, but ultimately we share all of these in our packages and we can walk people through, and we'll do a lot more presentations with the macroeconomic data. But Oakland has, really three main things that are trending for it in its demographics. One, the area itself, population growth. Oakland is in the path of growth. You want to be in a growth market, adding people of a certain wealth and income requirement, because that bodes well for multifamily rents and occupancy levels. And the fact that we're an urban core still adds economic diversity, which means that you have multiple different types of industries and job creation, and you're diversified. It's not like moving to a rural town where they really have one way of making money. And if that one way is threatened at all, it won't be able to produce the business plan that it mentioned. If it's a hotel resort and it's got bad weather and it's shut down, it's game over. There's nothing else for them to do. There's no way to hire other people to do other things and create jobs and or make that project economically viable. So when you talk to the pros that are in a multifamily investing industry, they're going to tell you want at least 200,000 people or more in the investing market that you're in. You want to have population growth, and you want to have income growth. The income growth is another great story for Oakland. The population growth might only register what they're calling 2 to 2.5% per year, but that 2.25% is accretive, and it's a whole lot of households that earn more than 150,000 a year, more than 100,000 a year. And then you have a handful of groups that make less than 60 and less than 75 and less than $100,000 a year that are moving out. So lots of high earners moving in and some low earners moving out. The net is that 2% growth. But up until 2026, you're expecting a total 12% bump in this column, showing you those 18,000 extra people in population, mostly high earners, all moving in. And we'll talk about the deliveries and the construction supply that we're expecting, which is far, far less than that population amount. There will not be enough housing in the Oakland market delivered at the same time that we're experiencing this growth. For apartments, we talk about demographic and age. Oakland has a significant amount of its population that's within our direct target market of age 25 to 44. Multifamily, either dual income, no kids, have not started families yet, and or just singles in the 25 to 44 bracket. Oakland is directly in that path. So when we look at income, we look at population growth, we look at diversity of the economics and job creation. Oakland fits all of these categories. This one, we are taking a look, net rents versus COVID cases. Urban core. Urban core has always been a story of mask mandates. When the mask mandates go away, people go back to the office, urban core fills up, market accelerates. The new variety of COVID comes out and you get Delta and you get all of the other variants. As soon as a mask mandate comes back for the offices, you see the urban core start to empty out again and the work from home items start to take their toll. So what you're seeing is a massive up and down that strictly mirrors the mask mandates. However, at this time, September, 2022, we believe that we've probably seen the last of the violent mask mandate changes and changes in policy here, where we'll start to see this normalize as the Labor Day return to work headline has really started to play out already. And office occupancies in urban cores are now at their highest since the pandemic began. The graph here, more focused, showing the rents and base rents on how they correlate to COVID cases. And then you see that massive EKG, but then normalization as it gets closer to the current time of August and September of 2022. Definitely affected rents, but Oakland was a story of two different things. It was a COVID issue in urban core, but it was also just a very, very heavy delivery of new supply in the previous cycle. Oakland was booming all the way through 2017, 18, 19, delivered a lot of apartment units in 19 and 20, and then ran into COVID, and it was a little bit of a double whammy, but has already started to churn through that. And we'll talk about the supply right here. This is just the perfect graph that you want to see delivering apartments and the competing apartments that you're going to see come online. Whereas this year, you're looking at 400 to 600 apartments that were actually being delivered. And that means they're construction complete, they're being put online, they're put into the pools. The Oakland market and demographics, based on job creation, population growth, and everything else, is expected to need at least 1,800 apartments per year just to meet the normalized growth. If there's not 1,800 units per year, that means that any existing units that are in lease up and any empty buildings are going to get that overflow. They're going to fill up. And then all of a sudden, there's going to be 0 apartments available. And if you look at 2023, there's really only just over 452 apartments that are expected to be delivered. 1900 Broadway is those apartments. There actually is no other competition. And then in 2024, it's nearly the same. 2025, they're not even sure. And at that point, you're still running an annual demand of 1,800 units per year, which means that if you're delivering less than a third of the current demand and growth for 3 or 4 years in a row, by 2026, we're looking at being 5,000 apartment units short. What that means is that you're going to have a supply crisis again. You're going to have rent growth, and the building is going to outperform. So when we are looking at the economics and the actual investment criterion behind these EB-5 projects and how to return the money to investors, we want to repay EB-5 loans. You want to perform for your preferred or common investors, common equity, that being, you need to have strong demand, limited or constricted supply, and population growth. That combination puts you in a great spot. Today, all the rage from the random EB-5 community is talking about rural projects. Rural projects, population of less than 20,000 people. You have no economic diversity as to the job creation coming from those large projects. They have one way to make money, one way to create jobs. And if anything happens, there's no explanation on how to save them. So urban core, high unemployment TEA, same set asides. There's a higher percentage for rural, but there's no other advantage to the category. It's just different. So you have a choice economically to roll the dice and take the risk on a rural location that's 100% all in on one business plan, or urban core, where you get a whole look at a lot more economic indicators and a whole lot more data to help you make a good decision on a trophy quality asset on transit in an urban core. So take a look here. We're going to open it up, investor Q&A. Any questions from the group on anything, could be EB-5, immigration related, economics, investing. We're happy to answer questions here. So I know I might have thrown a lot at you, but happy to answer some questions. Peter, if you've got one loaded up, you can go ahead.
I just wanted to say a moment that market data that we were just sharing with you, it's not coming from us, and just wanted to highlight that this is coming from the Concurrent Group, which is one of the leading real estate advisory firms in the nation that provides this type of market data, for banks and lenders and investors. And so this is a report that we obtained through the Concurrent Group, and for investors that are considering choosing Behring as their EB-5 partner, if you want to sign up for a one-on-one consultation, we can share this report with you, and like Colin said, it's not the prettiest, it's not the easiest to read, but it is chock full of great data. So for anyone who really likes to run through the numbers and the data, then highly recommend signing up for a consultation, and we'd be happy to share. So for questions, we have a couple questions now that we'll highlight. One is on adjustment of status petitions. And this gets to concurrent filing feature under the Reform and Integrity Act that was passed this March. So the specific question is asking the status on filing adjustment of status for petitions, I-526 petitions filed from inside the United States. And then what are the approvals and then timing for those. So again, just for everybody's benefit, it's nothing new in the EB-5, or I mean, in the employment-based space, but it's new to EB-5, where investors in the United States are able to file concurrently. That means they can file their I-526 EB-5 petition and their I-45 adjustment of status application at the same time, or within, soon thereafter. The key benefit here, of course, is that you are able, if you file for adjustment of status, you are able to apply for your work permit and your travel authorization. So we're seeing this now. We've had several investors already apply after the EB-5 Reform and Integrity Act last March, and after our successful lawsuit in June. So people immediately, like our existing investors, immediately started applying for adjustment of status as soon as this became law. And we had some of our investors get their EAD and advanced parole within 100 days. And that is getting closer to the pre-COVID processing times that we would normally expect from USCIS for processing these. But generally, I would still tell people that maybe 3 to 6 months on average for you to get after filing, for you to get the EAD and the travel permit. The other key advantage for filing adjustment of status at the same time is if you have potential child age out risks for any dependent children under 21 who are not already U.S. citizens. If you're applying for adjustment of status, then you're able to lock in the child's age for preventing them from aging out. And so that way the entire family is going to benefit from the green card while they're actually waiting for the green card to come in hand. So that's the question, or try to address that question about adjustment of status. It can be a very powerful feature for people. This enables you more flexibility so that you no longer are dependent on your employer sponsor. So this means it gives you more flexibility to start your own business, to join a startup that might not otherwise be able to sponsor you through H-1B and EB-2, EB-3 categories. Another question you have here is a couple questions. One, what is the waiting time for India for EB-5? So I encourage, we do post these on YouTube. So we do have a YouTube channel. We can put the link in the chat here momentarily, but yep. we do offer these for replay, and whether you'll get an email if you registered already, but you can also find these on our YouTube channel called EB-5. There last week, we did spend a lot of time focusing on the new October visa bulletin, and particularly for EB-5 investors from India. So I encourage you to look at that video, but just a quick summary here. October visa bulletin showed that there is a visa retrogression for Indian EB-5 investors in the unreserved visa category. So what that means, this is that investors from India who filed I-526 petitions before the Integrity Act, so before March 15th, are now facing retrogression. For our future investors who do not invest in $800,000 projects, but are investing in non-TEA, non-rural projects at the 1 million level, they will, they may face retrogression in the future because they're in the unreserved visa category. New investors considering applying for urban high unemployment projects, rural or infrastructure projects. Now, the visa bulletin is current for everybody. So there's no visa retrogression for those folks. So what is the waiting time? This is a moving target right now. There's a couple features or factors in motion in USCIS that's going to impact these processing times. One is there's just far fewer people filing petitions, and we have new reserved visa categories. So these visa set-asides give investors from India, China, Vietnam, other investors that are in these higher demand countries historically, a fresh start. So you're in a new line, new processing times, starting now. So the speed to green card will be faster than for folks who had filed before RIA, before the Integrity Act in March. The other factor that's in play here is USCIS is implementing a fee study. This will be completed by next year, and they're supposed to implement that and raise fees to such a level that they're hiring new staff and achieving processing times between 90 days and 240 days, depending on where the project is located. So for TEA projects, it could be as approved within 90 days. So we could see next year much faster processing times for folks. So ultimately, but right now, I would still say about 2 years on average. But there are, if you see that video, we do talk about different strategies for you to improve those times for you for the speed to green card.
Yeah, and for the individuals that are asking about applying from within the United States and doing what Peter mentioned as concurrent filing and everything else, that is far more expedited than if you're going to apply from outside the United States and go through consular processing. We have empirical evidence that 100 days was possible, and it happened to our investors. So that was encouraging. We've also seen just a lot more traffic on petitions getting issued as far as I-526 approvals and everything else. Everything is starting to come in now that the court case, the settlements, the RRA, all of these complications are starting to get behind USCIS, and they're really starting to make more progress, which is encouraging. So we're working on all that kind of stuff, but to get that 485, the concurrent filing is still really the gold standard as far as speed. And then there's a whole different conversation about mandamus actions in the event you believe USCIS is being unreasonable about the speed in which they're addressing your petition. And that's a whole different case. Typically, we're really only seeing the mandamus actions being used after there's an egregious delay at the I-526 stage of potentially 2 years or more. We've seen people be successful with it at far less of a wait, but the longer your wait, the better your argument is in front of a judge, and that changes things. But 100 days, if you're doing concurrent filing, has proven to be possible, which is a major improvement. The next question there, talking about the rates of return on an EB-5 investment, and this is actually something where our regional center at Behring Regional Center and our legacy funds and our breadth of options really changes things, because we actually have multiple different options. Peter, confirm for me if you can see the deck. I just brought up our basic options here. Let me know if it shows up.
Yes.
Okay. So we have 3 basic investment options. And Peter, you said you can see these?
Yes.
Okay. So the debt style max protection plans that we have, they are loan style investments. And just zooming in, because I know that text is a little small. These are really the most popular and kind of the traditional EB-5 is this one on the far left. It's a loan style investment, maximum protections and guarantees, all of the repayment provisions, covenants, restrictions, anything that goes into a construction loan. The debt style investment is truly the max protection. That comes with 100% equity pledges, depending on the sponsor and the project, has a whole different array of repayment guarantees, from corporate guarantees, personal guarantees, all kinds of different things to make sure that you have the maximum probability of being repaid the principal investment. And with that elevated level of protection, you do get a reduced rate of return, because it just represents the level of risk compared to other product types on the market. So then we slide to the right here, and our middle option, which is kind of our medium risk and return profile, and also goes after really what we call basic income. So the preferred return is 5%, but if you net out all the annual management fees and things like that, you're looking at a 3.5% net, very similar to a low risk corporate bond, significantly higher return than the debt style option and the max protection. But then it's still a fixed program where it's a fixed rate of return. It's accrued and paid out of cash flow from the project, but it's a middle ground. It's middle risk, middle return out of the three profiles that we have. The most highest earning profile is our common equity partners. Common equity, you are a private investor in a fund that invests in real estate. You're going to be a partner with us side by side. Our money is in this fund. We invest out of this vehicle, and we can't make money unless you make money. And the common equity is really targeting Wall Street level returns of trying to go after a 15% IRR per year throughout the duration of the investments. These are ultimately ownership of property, and the highest earning profile is our common equity. It comes with market risk. If the market rewards the project well, you make a ton of money. If the markets are tough and you're just not as successful, then the equity is going to reflect that. So high risk, high return, low risk, low return. It is just a strata based on personal need. Some people they're borrowing money from friends, family, unsecured loans. They absolutely cannot afford to lose $1 of this, or this investment makes up a vast majority of their life savings, and they really can't afford to lose their retirement. The debt option would make more sense. For people that are toward earlier phases of life, they're making pretty good money in their jobs, and they can afford to take a little bit more aggressive positions and more aggressive investments. Those people have tend to venture toward the common equity, because even though it might be the highest risk, highest return profile out of three choices, when you look at the entire investing universe, it's still investing in a multifamily apartment project in an urban core directly on transit in the best metro market in the United States. So if that's the case, if you compare it to retail in a mall or an office building, a hotel, some sort of ski resort, Ferris wheels, tourism, restaurants, if you compare it to the rest of the investing universe, we're still lower risk than almost anything out there. And this is our most, higher returning profile. So, not only are you looking at the structure of the investment or how much you can earn versus risk, but the quality of the assets we're investing in still puts this in a very, very reasonable risk return profile compared to other options. So hopefully that answers the question, like how much can you earn was the basic question. It was a very long-winded response, but you can choose. You can choose maximum protection where you don't earn very much, or you can choose maximum returns where you're targeting to hit the ball out of the park, hit a home run, make a ton of money on your investment. You can only do that with common equity, because the other two profiles do have a ceiling on the amount of money they can earn with a fixed preferred return. So that is to answer that question. If there's an additional question on top of that, which I guess there was two parts to it. So a lot of people do ask us, can I sell a property in 1031 exchange to invest in EB-5? Because it's the best of both worlds. I can defer any taxes that I made on a taxable gain on a property, and I can shove it into EB-5 and I can go after my immigration and my green card. That would be fantastic. Unfortunately, you're dealing with a very, very technical complication where the 1031 exchange needs to be invested into what they call a like-kind asset. So you're investing from one asset and investing into something identical to the same as what you were investing in before. So what you owned before was a fee simple interest in a property, and you're selling that asset and trading into now what is not a property. It's actually a security. You're investing in a limited partnership interest with a whole bunch of other people, and it's actually a completely different investment classification versus the property that you just sold out of. This is actually a common problem or a common complication with partners that are in commercial real estate buildings, where one of them wants to sell, but the others don't sell their pieces, and you're buying one partner out. The LLC, or the limited partnership, both of these entities sell a partnership through a limited partnership interest or an LLC interest. It's a security. And that's why we're governed by the SEC. It's the securities laws that govern our offerings, not really property or real estate law. So the fact that the EB-5 investment is actually investment in a security interest in a company that owns property, you're not able to take that 1031 trade and try to do that. However, the legacy fund in its future does envision a world of being able to do an UPREIT transaction. And an UPREIT transaction is when you're actually selling REIT operating units, where you're buying somebody's property and pulling it into the REIT, and you're trading them shares in your company to pay for their property. So as an example, somebody wants to sell their small apartment building or a house. And if they want to sell that house to the fund, then the fund would trade them, limited partnership interests or operating units. You'd be able to trade your property for ownership. And as long as that partnership is EB-5 qualified, you'd be able to do that. Currently, there's not a vehicle on the market that offers this, but in the future, our legacy fund, after there's stabilized cash flowing multifamily apartment buildings, if we do fold that into a REIT structure that's more tax efficient, that REIT would be able to actually purchase your property and exchange units, and that would be EB-5 qualified. But that is something that needs to come in the future. It's not something that we're doing yet. It doesn't make sense at this stage of our cycle, but it is the closest you can get to that 1031 into an EB-5 project. So we're essentially telling you that it's on radar and that we're aware of trying to make that benefit possible. It will just take more time, and it's not available today. The third one, Peter had already answered as far as the wait times for India. And the real difference, like Peter had mentioned, is whether you're applying now after the RIA has passed, and if you're in the United States with concurrent filing, or if you're already filed pre-RIA and not in the United States. Very different answers. But the best classification you can have is being Indian born here in the United States, filing your I-526 today. That is still a very, very fast route to getting your EAD while India is current. That's the important part.
Colin, while we're talking about, the investment options and different structures and things of that nature, what about EB-5 investors looking at the legacy fund? And sometimes they'll ask whether they can use a self-directed IRA,
right,
or others. Is that available for?
It is. And this was specifically something that came out early in the legacy funds launch, where we had our H-1Bs. They're here in the United States. They've got a pretty decent retirement account that they've built up, 401k, self-directed IRAs, and the ability to kind of move things around. You are able to invest in the legacy fund using IRA, self-directed IRA accounts. It may require switching the custodian, where you're moving to a new IRA custodian or manager, but they could invest in the security that is the legacy fund with retirement funds and IRAs. And that is totally doable. And you don't need to take the 401k loan. You don't need to liquidate and take the penalties. You can invest directly from those self-directed IRAs and get that done. So that is a major advantage of the legacy fund, because we've actually gone through the effort and the care to make that fund qualified for those vehicles to participate. So that is a major advantage and very, very tax efficient. And giving up any sort of penalties and or funds out to just pure taxes is painful for everybody. So we went and tried to solve that one real quick. So
we have a question
looks like we have one question come through there
about direct jobs. So the question is about the Integrity Act changed the definitions or job creation requirements slightly, requiring that 10% of jobs must be direct for a regional center project if the construction is 2 years or longer. If the construction project is fewer than 2 years, then the direct job creation requirement needs to be 25%. So the key question, here is, does our project create direct jobs to satisfy the Integrity Act's change in job creation rules? And there's a couple points to keep in mind here. One important aspect is direct jobs under the Integrity Act for regional centers is still not the same as direct jobs for direct EB-5 investments, where you're opening a business, buying a business to where you're investing directly. You're not investing through a regional center. So generally speaking, and we'll probably do a video on this here shortly and talk about job creation, how do we satisfy job creation, and talk about different economic models and so forth. The short answer is that direct and indirect jobs through a regional center are demonstrated through economic models. It's not the same as showing direct job employment on the ground, boots on the ground, in payroll employees. That's different. That is a direct EB-5 approach. So you can still rely on models, and you'll see here that our models that we create for this particular project, 1900 Broadway, it's about 50-50. 50% direct, 50% indirect total job creation throughout the construction of this project. So you can see if you see our screen, we're scheduled to create almost 3,200 jobs. It's more than twice the amount necessary if for all EB-5 investors in the project. And we're about 50-50 in that direct indirect ratio, where we only need to be 90-10. So we are satisfying the Integrity Act. But I just want to highlight again, direct jobs under the Regional Center program, even under the RIA, is something that's established through economic models. Under a direct EB-5 investment, it is established through payroll records, W-2s, and evidencing those positions for more than 2 years. So there's a big distinction there, and that's one of the biggest distinctions between going the direct EB-5 route and the regional center or indirect EB-5 route. And there's a big difference there in the level of immigration risks, in addition to commercial risks. So at one point, I think we'll stay tuned for a video on that. We'll highlight through those direct versus regional center.
Yeah, and to comment on it a little bit further, just kind of imagine the job creation world of EB-5 is split into two buckets. You've got direct jobs and indirect jobs. Direct is, like Peter mentioned, you're hiring for a restaurant. You got real people, W-2s, tax returns. Those are directs. Then you've got indirect, which is the modeled jobs. So this is done through the economic models like RIMS 2, like this report that we have. Those are indirect jobs. But then the indirect and the models, the RIMS 2, Implan, Redine, all these economic models, they within the model have a designation for directly induced jobs where your project will directly create this economic impact because of your project and your spending and doing this, and your building and your construction, your furniture, fixture, equipment, your architecture, your engineering. This is going to be a direct job because of what exactly you're doing with the project. Then in the indirect bucket with the models, it's direct and indirect jobs. So it's almost a double indirect. The reason I say that is because you are still going to have a ripple effect in the economy with your project, and it's going to be induced spending that ripples throughout the economy, where it's not really the construction of your project that is the indirect job under the indirect category. You're now going to induce spending by everybody involved. Like the construction guys are going to park cars and pay for parking. They're going to get lunches throughout the day. They're going to get haircuts. Then it's going to turn into, shops opening down the street in order to serve the 1,000 people that live in your building. It's the indirect job creation and induced spending of the indirect category. What USCIS says is that their direct jobs can come either from the direct hiring and real people, or the direct calculation of the direct impact in the economic models. So that's why it's a little bit harder to follow, is because it's direct jobs within the indirect model. And the direct jobs count for USCIS, whether it's direct hiring of real people or directly within the models. So our project, lucky for us, actually has no change. Our direct job counts in the model were still massively over 10%, and actually more than the indirect. And, like Peter said, it was, call it a 50-50 spread. The minimum was being a 90-10 spread. So with these construction-based projects that create the bulk majority of all of their jobs through construction alone, and as long as the project does last over 2 years, that direct job creation number will be significantly higher and substantial. You will get a much, much lower direct job creation if the construction project itself does not last longer than 2 years. That is a kind of a special variable item that goes into the RIMS 2 model. There's just a much higher direct job calculation if that economic impact does last for a sequential 2 years or more. So I know this is one of the deeper topics of EB-5 and how the economic modeling works. Lucky for the EB-5 investors, this is a non-risk category as far as getting denied, and this is not a hidden item that will catch you later. This is a very low risk question and a low risk concern for EB-5 investors. So it might sound like an extra requirement and like something that's new and potentially scary, but ultimately very, very low risk.
One thing to add on to that is these models, and there are 2 or 3 generally used across the nation by EB-5 projects. These models are part of an economic impact analysis or job report that regional centers will usually retain a third party, not always, but usually retain a third party economist that will run these calculations for you and verify, look at the construction budget and then the qualified eligible job categories and the location, and as Colin mentioned, the time period, and then create the estimated number of jobs, direct and indirect, through the construction. This model is part of the package that's provided along with the business plan and offering documents that's presented to USCIS, typically as part of what was called the I-924 exemplar petition. And it's now called, in the new regime for new projects, it's the I-956F. But in the I-924 exemplar, and the key word is exemplar because that's where all the documents are being submitted. It's not a hypothetical project. It's a real shovel-ready project. When you're submitting that to USCIS and that's approved by USCIS, USCIS is then concluding that not only is the project compliant with EB-5 rules, but that it determines or concludes that the project, based on its business plan and its job report and model, will reasonably likely create the jobs it says it will. As long as it continues its construction, it'll create those jobs. Once it reaches that conclusion, USCIS will then defer to that judgment when they pick up new EB-5 petitions later. So then at that point, the project is what we call approved, and they're looking at your I-526 petition and focusing on your source of funds. So that's why Colin says it's a relatively low risk question or low risk concern at this point for job creation for two reasons. One, the 1900 Broadway I-924 has been approved, approving the business plan and the job report that was created by Baker Tilly, a third-party economist. And secondly, we're more than halfway under construction. So we're creating 100 jobs a month for everybody, more than covering all investors at this point for the project.
Yeah, and another item that kind of encapsulates a lot of these the risk questions, and where people are super worried about it, is there something that can come out of the woodwork and really mess this up? Like, what am I not seeing? What do I not know? And when you see a project like 1900 Broadway, yeah, it's 22 floors out of the ground. It's half built, it's got glass on it. It's making good progress. That's on the surface. Yes, it is. But even before that construction really got to that point, it has been thoroughly vetted by multi-billion-dollar companies who knew exactly what to look for in the form of the bank. The bank, Bank OZK, and then our partners at Essex Property Trust, a publicly held, highly respected REIT, the 20 billion plus market cap, depending on the day of the stock market. And they have also done all the homework that we ever could have done to protect capital and to ensure that there was a very good chance of getting the money back and a profit. And with that, they have reviewed the risk, and they've reviewed it in very grave detail. They've gone through structural reports. They've gone through soil reports, looking at underground conditions. Where can this thing get snagged? Where is the risk? Do you have enough money in the budget to account for X, Y, and Z? If there are cost overruns, who's going to fund them? If there's a problem, who's going to take care of it financially, guarantees, covenants, whatever it might be? That stuff is all in place. If you have a project that does not have a bank loan yet, there is a chance that it may not get one. And if it doesn't get one, what are they going to do for the job creation? What are they going to do to preserve capital? How do those things work? And if there's a great contingency plan in place and a backup for if the original business plan does go in a different direction, what do they do? And if there's one of those that if something's not in place as a backup plan, you're going to have a problem. So when you have all of the check boxes that we're talking about, where you have the bank loan, you're fully funded, you're under construction, you've gotten past the below grade complications that come with foundations and moving dirt and things you can't see. Sometimes there are items that are completely unexpected below grade, and it's literally, you don't know it's there until you start digging. But once you're past that stuff and you're above ground, the construction process is very much under your control. A lot of risk has been mitigated, and it's really about just staying on task and delivering the building. So, the sequence of knocking out risk step by step in the construction industry is very much possible. I do recommend construction projects, whether it's ours or anybody else's. It's just very transparent. The job creation is very tangible. It's easy to record. It's easy to put into a report using these economic analysis. When you're looking at direct jobs, like pure direct, not in the mall, but when you're actually looking at real W-2s, tax returns, and people, and you're looking at a goal to hit 10 full-time jobs per investor, and it has to show up on a certain date, and the exact date, which is the I-829. And if you don't have those 10 jobs on the exact date that you're filing the 829, if you're going with direct employees, you now have a problem. It could be surmountable. You could get exceptions from from USCIS. However, it is just so much easier and so much lower stress to just use the RIMS 2 regional center and indirect job creation through spending and construction. So yeah, we've been doing this for 10 years now, and construction is by far the most reliable source of job creation for sure. Do we have more questions from the group? We've been on for an hour or so, and like we appreciate the patience getting started, but with the people that are here, is there an additional question or topic that anybody wants to hear more about? Or do you just want to send us a message that this was worth your time and that you appreciate it? That'll be appreciated too, either way. But if we don't have any more questions, if that's all, we can wrap up, and we'll just catch up next week when people have more questions and more items to address. But I guess the last thing that we can mention is that we are in the process of checking with the Department of Justice on the next date and the first date for our USCIS interaction and our meeting regarding the implementation of our settlement, which will be a first direct one-on-one discussion with USCIS, where we're going to be able to have a direct conversation and get a lot of questions answered and make sure that everything is on board with our settlement and the implementation of the RIA in accordance with the court judgment and the settlement agreement. So if you guys have questions or things that you would like brought up or clarified in those USCIS calls, please submit those questions however you like, whether it's through email, these chats, call us. We do have an opportunity to have a direct conversation with USCIS, and we will make full use of it, clarifying anything and everything that's out there regarding EB-5. So that's being scheduled now. We expect it to take place within the next month or so. And that will be a tremendous opportunity to get clarity on anything that might be a little bit murky here with the rollout of the RIA. So that's the other piece of big news that we can kind of close on. Any questions? Last call, I guess. Peter, do you have any closing thoughts, or should we close out?
No, I think that's a great start for our second round of office hours. Again, I just encourage people to email us or contact us with your questions, and we'll be happy to incorporate them and make sure we cover them as topics in future office hours.
Okay, well, thank you, everybody. We appreciate you joining and the interaction and being able to chat, answer questions. We hope this was helpful, and we'll continue to host this going forward. So please join on the next events every Thursday, 2:00 Pacific time. We'll be here, and again, you can contact us anytime, but this is a chance for direct activity as a group. So thank you, and we'll see you soon.